Hello, everyone, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 24 of 2026, and this week's headline is clear. The war premium has cracked, but the pen has not yet landed.
Exactly. Brent crude fell sharply this week, moving toward $89 per barrel, its lowest level since March.
That is a major shift from the war premium highs we saw earlier in the quarter.
It is. And the driver was another diplomatic breakthrough. President Trump suspended planned military strikes against Iran and said a deal to reopen the Strait of Hormuz could be signed as early as this weekend.
So the market is starting to price a real resolution.
Yes, but with an important caveat. The agreement still has not been signed.
So the pen is hovering.
Precisely. The outline is there, the expectations are building, but the final text has not been confirmed by both sides.
And the region is still not fully quiet.
Correct. The same week that produced the breakthrough also saw U.S. strikes on Iranian radar and drone sites, followed by Iranian missile responses across the Gulf.
So this is not normalization yet.
No, it is de-escalation with risks still attached.
But the framework does appear more concrete than before.
It does. The reported terms would require Iran to clear all mines from Hormuz within 30 days of signature, and would also prevent tolls on the strait.
That 30-day clock could be very important.
It could define the next chapter. If the deal is signed, July becomes the month when the strait moves from reopening in practice to normalizing in structure.
And that matters directly for recycling supply.
Absolutely. The two forces that kept older vessels trading, rather than heading for recycling, are both weakening now.
Oil and freight.
Exactly. The bunker cost floor is coming down with Brent below $90, and freight has also cooled for the first time in this arc.
The Baltic Dry Index eased to around 2,818, down from the June 1st peak above 3,200.
And Capesize earnings fell to around $40,000 per day, down from almost $49,500 the prior week.
Still healthy, but no longer at the strongest level of the quarter.
Correct. The incentive to keep older tonnage trading is beginning to soften.
But once again, the timing is difficult.
That is the market's irony this week. The bunker floor and the freight premium are finally easing together, just as the beaches close for the monsoon.
So even if sentiment improves, the operational window is not there.
Exactly. The monsoon now rules the beaching calendar.
Let's move through the recycling destinations, starting with Bangladesh.
Bangladesh remains steady. The taka held around 122.75 against the dollar, staying at the floor of the band that has contained it throughout the conflict.
That currency stability has really been one of Bangladesh's strengths.
It has. The taka held through the Brent spike, the Brent collapse, the rupee volatility, and the lira's record lows.
What about steel?
Local steel plate prices held at around 65,000 taka per ton, or roughly $535 per ton.
So Chattogram remains constructive but quieter.
Exactly. Chattogram has now settled into the monsoon pattern. Beaching cycles are reduced, and yards are working through tonnage delivered during the late May tide windows.
The letter of credit pipeline remains open, though.
Yes, and that is important. Financing is not the constraint anymore. The issue is supply, and now also weather.
So Bangladesh enters Q3 with demand still intact.
Very much so. Full plot capacity, cleared financing, a resilient currency band, and pricing that remains above Along and Aliaga at the ton level.
But the next 8 weeks are governed by the monsoon.
Correct. The deal, if it lands, governs what comes after the monsoon. For the first time since February, the second half looks more constructive than the first.
Moving to India, the rupee held its recovery.
Yes, USD INR stayed near 95.40, marking a fourth consecutive week of recovery from the late May record near 96.97.
Helped by Brent falling toward $89.
Exactly. India's import bill is highly exposed to energy flows through and around Hormuz, so the collapse in the war premium gives the rupee a real tailwind.
Earlier, the recovery was more about expectations.
Correct. Now, there is a fundamental element too. Lower Brent directly helps India's external account and inflation outlook.
But the relief is still conditional.
It is. The agreement has not been signed, the demining period has not started, and damaged export infrastructure still has to be brought back into normal operation.
So the rupee has improved, but the risk has not disappeared.
Exactly. The record has receded, but it has not been repealed.
How is Along looking?
Local steel prices softened during the week. moving from around 38,500 rupees per ton to around 38,000, with a brief dip near 37,800.
In dollar terms, that is around $398 per ton.
Correct. India remains the lowest priced subcontinent destination, with the gap to Pakistan near $295 per LDT.
That is still a large gap.
It is, but India's structural position is improving. The rupee is steadier, the bunker floor is falling, freight is easing, and more than 110 compliant yards remain ready.
But again, the rains rule the present.
Exactly. Alang has the compliance and improving macro conditions, but the monsoon now controls operations.
Let's turn to Pakistan, where inflation was the big headline.
Yes, Pakistan's May CPI rose to 11.7% year-on-year, up from 10.9% in April.
The highest reading since June 2024.
Correct, but the monthly picture tells a very different story.
Monthly inflation dropped sharply.
Exactly. Month-on-month inflation fell to 0.5%, down from 2.5% in April.
So the annual number is still rising, but the underlying shock is fading.
That is the key point. The headline looks hot because it carries the accumulated war shock, but the monthly pace suggests the pressure is easing.
And the rupee seemed to agree.
It did. USD PKR held around 278.39, sustaining its strongest level of 2026.
Pakistan remains the only subcontinent currency to have appreciated against the dollar through the conflict.
Correct. The market looked through the annual inflation print and focused instead on the lower monthly pace, the Brent collapse, and the state bank's earlier rate hike.
Steel remains firm too.
Yes. Local steel plate prices held at around 195,000 rupees per ton, or close to $700 per ton.
That keeps Gadani at the firmest pricing level in the basin.
Exactly. The gap to India is now near $295 per LDT.
Pakistan's wartime advantage may now be tested.
That is the strategic point. Gadani benefited from the Gulf proximity premium while Hormuz was disrupted. If the strait normalizes and the demining clock begins, that premium may slowly erode.
So Pakistan won the war quarter.
It did. But the peace quarter will test how much of that strength was structural and how much was circumstantial.
Finally, Turkey.
Turkey remains the outlier. May inflation rose slightly to 32.61% year-on-year, up from 32.37% in April.
But just like Pakistan, the monthly numbers softened.
Exactly. Monthly inflation fell to 1.71%, down sharply from 4.18% in April.
So the annual rate is creeping higher, but the monthly pulse is fading.
Correct. The energy shock is starting to ease, but the accumulated annual pressure is still visible.
What is the central bank doing?
The Central Bank of Turkey has suspended its year-end inflation forecast range, citing high uncertainty, while maintaining a 24% year-end target.
That sounds like a sign of strain.
It is. The bank is effectively acknowledging that the disinflation framework cannot yet be re-anchored with confidence.
And the lira?
USD Turkish lira steadied near 45.85, just off its recent record. The broad dollar eased, and Brent below 90 offers Turkey the disinflation tailwind it has been waiting for.
But only if the deal is signed and the lower oil price holds.
Exactly. Turkey, like everyone else, is waiting on the pen.
And in recycling terms?
Aliaga remains structurally uncompetitive for mainstream tonnage, with prices around $268 to $290 per LDT.
So Turkey remains an EU-regulated tonnage market.
Correct. Compliance, not price, continues to define Turkey's role.
Looking at the broader picture, week 24 feels like a turning point.
It does. The war premium has cracked. Brent has moved below 90. Freight has cooled. Currencies have repaired. And inflation shocks are beginning to fade on a monthly basis.
But the ships still have not arrived.
Not yet. The first chapter of this market was defined by absence. Demand was there, financing was there, pricing was there, but tonnage did not come.
The second chapter may be different.
Yes, if the deal is signed, the 30-day demining clock begins. Hormuz normalizes through July, and older tonnage may finally face the question the war deferred.
Whether to keep trading or finally head for recycling.
Exactly. But for now, the monsoon rules.
The premium cracks.
The pen hovers.
And the beach waits.
That's the story of week 24.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights. If you would like to get the complete market update delivered to your inbox, subscribe to GMS Weekly through the GMS website.
Until then, stay safe.
And thank you for listening.